Welcome to the session. Today we'll be talking about teaching the new tools of monetary policy. I don't plan on saying anything controversial, but if I do, keep in mind that my views are my views alone, not those of the Federal Reserve Bank of St. Louis, the Federal Reserve Board, or the Federal Reserve System. So we're going to start with just a little quiz, and I'd like to ask you, what is the Fed's primary tool for influencing the federal funds rate? And you can put your answer in the chat box. All right, so we have 2 Ds, which means that we are at running a pretty good score. So when we started doing these presentations, we would ask this question, and almost everyone said A. There were a few that said B. There were a few more that said C. And there was hardly anyone who chose D. But as it turns out, D is the correct answer. So we're going to talk today about some of the changes that have happened since the Great Financial Crisis, how the Fed responded to the Great Financial Crisis, and how that really changed the way the Fed does monetary policy these days. So monetary policy has changed. Some instructors continue to teach the old models, assuming that the changes are not significant. My co-author and I, Jane Eyrig, have been on this project for about 3 years, and we set about a mission to make sure that people knew that the changes had happened and they were supported as they made the changes. And a lot of people have made that change, but really there's a lot of a lot of variation in the excitement as to whether or how much people are willing to change. So we're gonna talk today about, has policy changed enough to justify changing instruction? So to do so, we're going to take a trip back in time. So we're going to go back to the year 2008. If you remember 2008, Senator Barack Obama was Time Magazine's Person of the Year. He was running for the office of President of the United States. His running mate, the vice presidential running mate, was a guy named Joe Biden. And we know how that election played out, and the succeeding elections. So if you think back to that point in time, it was a long time ago. There were other things happening. So for example, it was that same year that the Fed stopped using its old policy toolbox. Okay. And that old toolbox had 3 tools in it: open market operations, the discount rate, and reserve requirements. Okay, now almost everyone's textbook still has these 3 tools as the Fed's toolbox. They might have added a 4th called interest on reserves, but most textbooks have essentially thrown a new tool in the old toolbox. Today we're going to talk about the fact that the old toolbox needs to be tossed out because the Fed hasn't used that toolbox since 2008. So let's do a quick review of the way the Fed did monetary policy prior to 2008. Okay, this is a diagram that you see it's a common supply and demand approach that is common in textbooks. And so you have a downward sloping demand curve, you have a vertical supply curve, and the way the Fed would shift the federal funds rate, which is the Fed's policy rate, is by shifting the supply curve back and forth just by small amounts, right? And the way it shifted that supply curve was through open market operations. And so the Fed would go into the open market, specifically the trading desk at the New York Fed. Open market trading desk would interact with financial markets, and they would buy and sell securities in the open market. And by buying and sell securities, they would increase and decrease the supply of reserves in the banking system. Okay, and that shifting of reserves in the banking system would shift that supply curve back and forth. And so here you see in the animation, the Fed lowering the federal funds rate, okay, by shifting the supply curve outward. Okay, that was the old method, and that served the Fed well for many years. But in 2008, things changed. And if you remember that time, the reason it changed is because of the global financial crisis. So 2007 to 2009, that was the time frame that we think of as the Great Financial Crisis. And of course, there was a recession associated with it. During that time, the Fed lowered the target range for the federal funds rate to 0 to 25 basis points, right? So sometimes you probably heard that referred to as the zero lower bound, right? So other central banks have played around with negative interest rates. Here in the United States, the Federal Reserve sees 0 as the lowest for pushing interest rates. And so the Fed lowered interest rates to 0, or that 0 lower bound, and kept them there until 2015, okay? But in addition to that, the Fed used what was called large-scale asset purchase programs. Everyone else called them quantitative easing. It's, different terms, same activity. And those activities were really about buying different types of assets. So typically, open market operations is short-term treasury securities. Large-scale asset purchases of quantitative easing were kind of longer-term bonds or different types of assets that would affect different types of interest rates. Okay, and so on this graph below, this is a Fred graph. If you're familiar with Fred, this is a free data website that's hosted by the St. Louis Fed. And you can find almost any economic data you're looking for is on Fred, and you can use it to create graphs. But the purpose of this graph, this is the total reserve balances maintained by Federal Reserve banks. So this is reserves in the banking system, okay? These are held on deposit at the Federal Reserve. There are data points down here, okay? It looks like there's no data, but relative to the size of the reserve balances that happened starting in 2008 in response to the Great Financial Crisis, and even into more modern times, these are just kind of little blips. Okay, these purchases of assets during this period of quantitative easing boosted reserves in the banking system to $2.8 trillion. Right, so you can see over here on the graph, this is 2.8 trillion, and at a few different times in this post 2014, it touched that level. So that posed a little bit of a problem in that if we take that supply and demand approach and we look at before 2008, we see that familiar looking graph. And for that system to work, the old toolbox, the supply curve had to be in the downward sloping portion of the demand curve. And the reason it had to be there is so that when you shifted the supply curve back and forth a little bit, you saw the movement in the federal funds rate, okay? But in response to the Great Financial Crisis, the Fed had bought so many assets through quantitative easing and other measures that it pushed the supply curve way out to the right, and it was in the flat part of the demand curve, right? And that was the whole purpose. You wanted to lower the federal funds rate to 0, and you did so by buying up lots of assets. So you push the supply curve out into this horizontal part. In order to raise interest rates, then the Fed would have had to unwind those assets relatively quickly. A lot of assets in a short period of time, which probably wouldn't have been a good situation for financial markets. But at the same time, the Fed had been talking about using a different approach for quite some time, using different tools. In fact, other central banks around the world had adopted a new mechanism that focused more on interest rates than the money supply. And the Fed took this opportunity to introduce a new framework that was similar to the ones that have been tried out by other central banks. And that's where we get this framework. This is monetary policy with ample reserves. Now, this is what the graph looks like. It looks in some ways similar to the other graph, and in some ways different. One of the defining features is that the supply curve, still vertical, is in the flat part of the demand curve, okay? And that's on purpose, right? So when the supply curve is in the downward sloping portion, we call this framework limited reserves. But when we push the supply curve out here to the flat portion, we call it ample reserves. And the reason we want that supply curve to stay in the flat portion is so that we can shift supply back and forth as needed without it influencing the federal funds rate, okay? We're going to influence the federal funds rate using different tools. So in other words, supply is not going to be the mechanism we use to shift the federal funds rate. Rather, we have these new tools, okay? The interest on reserve balances rate, which I'll talk about in more detail. We have a supplemental rate or a supporting rate called the overnight reverse repurchase agreement rate. And then a holdover from the old toolbox here is the discount rate. So we're going to talk through each of these briefly as we go through this. So this is the Fed's new toolbox. On the left side, you see the tools. The first three tools have a rate, okay, associated with them. In fact, sometimes we just refer to it as the rate, but technically the tool and the rate are two different things. These are administered rates, which means the Fed sets them directly. Notice that, you know, in the old regime, in order for the Fed to shift the federal funds rate, it had to go into the market and, you know, buy and sell Treasury securities at such a scale that it would cause the federal funds rate to move towards the target, right? In this new situation, we have rates that the Fed actually sets, and those rates guide the federal funds rate. But I'm getting a little bit ahead of myself here. So these are the three tools: interest on reserve balances, overnight reverse repurchase agreement facility, the discount window, and the rates are the interest on reserve balances rate, the overnight reverse repurchase agreement rate, and the discount rate. Now, you'll notice that open market operations here is listed. I've listed it as number 4. And I've even color-coded it a little bit differently because it's really a different kind of tool. We'll get to this later in the presentation, but open market operations are really there just to make sure that the reserves remain ample, right? To make sure that the conditions are right for using the active tools or the administered rates. All right, so we're going to take each tool one by one. So first tool, interest on reserve balances, okay? This is the primary tool. Back in the old mechanism, if you teach the Fed a monetary policy, you know, you would talk about open market operations, discount rate, and reserve requirements, but chances are you would spend almost all your time talking about open market operations because that was the primary tool. In this new regime, interest on reserve balances is the primary tool. So if you're going to talk about one tool and how the Fed uses it to guide the federal funds rate, it's going to be this one. Okay, interest on reserve balances. Interest on reserve balances is the interest rate that banks earn from the Fed on the funds they deposit in their reserve balance accounts. Okay, so back in the day when the Fed required reserves, they required banks to hold a certain amount of their funds on reserve at a Federal Reserve Bank. They didn't pay any interest. And, you know, that was always kind of a controversial thing with banks because they could be using those funds to buy assets or make investments or to lend to people or lend to other, you know, institutions in the federal funds market. But, you know, the Fed required them to hold these funds without being compensated. So actually, this move towards paying interest on reserves was something that banks had been calling for quite some time. So now banks can hold funds on reserve at the at their Federal Reserve Bank and receive an interest rate. This is a risk-free investment for banks, and it's liquid, so they can access that money anytime, and they get this very safe, guaranteed return. So interest on reserve balances, the reason this is an effective tool is because the Fed sets this rate, and by moving this one rate higher and lower, this one rate steers the federal funds rate. Okay, so we're going to talk a little bit about why or how the interest on reserve balances rate is effective at steering the federal funds rate. So it's really relies on two concepts. Okay, first one is reservation rate. The interest on reserve balances rate is a reservation rate. It's the lowest rate that banks are willing to accept for lending out their funds. Okay, so if you're a bank and you have all these investment options, and one of those investment options is the return that you can get by depositing funds at the Fed, that investment again is risk-free and it's liquid. You can access the money anytime and it's guaranteed to never go anywhere. Okay, it's always going to be there. And so you would never accept less than you can get from the Fed because why would you, right? So that becomes your baseline. That becomes your reservation rate. Of course, you're going to want to get more for your funds if you can get it elsewhere, but you'll never take less than the interest on reserve balances rate. So it serves as, again, a reservation rate. Arbitrage. Arbitrage is something that doesn't necessarily appear in your textbooks, and it can sound intimidating, but actually it's a pretty simple concept once you break it down. So arbitrage is just the simultaneous purchase and sale of funds or goods in order to profit from a difference in price. Okay, and arbitrage happens all the time. We just don't call it arbitrage. It's when you see a difference in the price for what you can buy something and sell something, and you decide, or someone decides, to profit from the difference. So they buy it in one place and sell it in the other. And when that happens on a grand scale, arbitrage tends to pull those prices together so they become the same price. So let's talk about an example. So here's our central banking example. So let's say that you're the bank at the bottom, okay, and you have some funds and you're looking for a return on your funds like banks do. And two of the safest options and most liquid options are you can lend the money in the federal funds market, or you can deposit the money at the Fed and earn the interest on reserve balances rate. Okay, again, these are both overnight, liquid, safe investments, and they're two viable options for you. But you'll notice that there's a difference in these two rates. There's not supposed to be, because I just said that the interest on reserve balances rate steers the federal funds rate. Okay, but let's imagine that there is a difference. Okay, if you're that bank, how can you make a profit? There's an opportunity here for you. And you can chat in the box, or feel free to unmute if you want. It's a small group.
If I was the bank, I would put the money on the IORB and maybe take that 0.5% and put it on the other.
Okay, right. So you're seeing that there's a difference. And so one of the opportunities that you can do is you can borrow money in this market. So you borrow money over here at 2, and then you deposit it at the Fed for 2.5, right? So you could earn this profit of 0.5% on all this money. And 0.5% doesn't sound like a lot, but if you're a bank, you have access to a lot of funds, and it turns into a lot of money. And remember, there's no risk in this, right? Both of these are transactions with no risk. And so you borrow money at the federal funds market, you deposit it at the Fed, and you earn 50 basis points. Of course, your bank isn't the only bank that sees this opportunity, and if they didn't see it to start with, they'll notice that this is happening. And so other, people in this market jump in, and they all start making this same transaction. Okay. And as they do, it increases the demand for reserves and pushes the federal funds rate higher. Okay. That increase in demand for federal funds pushes that rate higher until the difference disappears. Okay. So arbitrage is really just a guarantee that these two interest rates will move in lockstep, okay? Because if there is a difference, banks will see an opportunity to profit and they'll close the gap, their actions will close the gap. And so because the Fed sets interest on reserve balances directly, it can shift that rate up and down, okay? And by moving that rate up and down, it moves the federal funds rate up and down. Let's do another example. Now, you know, we're going to keep the interest on reserve balances rate the same, 2.5%. Okay. But now let's imagine that the federal funds market, the federal funds rate is at 3. Okay. Again, this normally doesn't happen. Okay. But this example is there just to show that arbitrage guarantees that if there is a gap, it will close quickly. So in this scenario, if you're the bank, you decide, I'm going to take my money out of the Fed. I'm going to withdraw from my reserve account, and I'm going to lend it in the federal funds market at 3%. Okay. So you're going to get that same profit margin. Okay. Again, these are both safe investments. They're both liquid. There's no risk in doing this. You're just taking advantage of the difference in the market. But as you and other banks do this, and you start supplying funds to the federal funds market, the increase in supply will push down the interest rate. And pretty soon that difference disappears. Okay. So really arbitrage guarantees or ensures that any gap between these two funds or these two rates gets closed quickly. And so because of this scenario, the Fed can simply move the interest on reserve balances rate higher and lower, and it will steer the federal funds rate higher and lower along with it. So when the Fed sets the target range for the federal funds rate, or when the FOMC, the Fed Open Market Committee, which is the group of, within the Federal Reserve System who actually set the policy rate. Okay, so when that group sets the target range for the federal funds rate, then the Fed sets the level of the interest on reserve balances rate to steer it into that target range. Okay, so the FOMC, lately they've been raising interest rates, right? If you've been watching the news, you've been hearing about some pretty aggressive rate hikes, 75 basis points per meeting, which is more kind of assertive, aggressive than they usually are. But with inflation the way it is, that was the decision the committee made. So as they raise the target for the federal funds rate by 75 basis points per meeting, they're also raising the interest on reserve balances rate by about the same amount. And that shifting of the interest on reserve balances rate is what moves the federal funds rate along with it. So let's do a little scenario here. On the left side, it says, how does the Fed raise the federal funds rate? They would, when the FOMC raises the target range, the Fed also raises the interest on reserve balances rate. Okay. And when they raise that interest on reserve balances rate, it steers that federal funds rate into the target range. How does the Fed lower the federal funds rate? Okay. Just the opposite, right? When the FOMC lowers the target range, the FOMC lowers the interest on reserve balances rate, and that steers the federal funds rate into the target range. Okay, so key point here, interest on reserve balances is the Fed's primary tool for influencing the federal funds rate. So this is what it looks like in recent years. So the Fed lifted off 0 in December of 2015. Okay, so if we look at our graph here, this is 0 right here. And so the federal funds rate, was at 0 from 2008 all the way to 2015. And so this is what we call liftoff. It's the first time that interest rates were lifted off, what we call the 0 lower bound. The dotted line is interest on reserve balances. The red line is the federal funds rate. So you can see that when the Fed first lifted off, the interest on reserve balances rate is at the top of the target range. This gray area is the target range for the federal funds rate. So the goal here is to keep the red line at about the middle of the target range, to keep the federal funds rate kind of floating in the middle of the target range. Okay, so we have the interest on reserve balances rate at the top of the target range, and the federal funds rate is floating right here in the middle. Okay, and as you can see, as the Fed increases the target range, it keeps that rate at the top of the range, and you can see that as we climb here, that the federal funds rate is getting closer and closer and closer to the interest on reserve balances rate. so much so that it's starting, instead of being in the middle of the range, okay, it's moving towards the top of the range. And so starting here, the Fed, keeps the interest on reserve balances rate not at the top of the range, but a little bit below. And you can see that the federal funds rate is trading almost at exactly the interest on reserve balances rate, right? We're seeing the gap close, so they're almost indiscernible. And that continues. We keep going down. Okay, this is COVID. During COVID, the response was to lower interest rates again to zero. And you can see that the Fed uses interest on reserve balances to keep interest rates at zero, keeping it in that range. And now you can see the more recent increases in interest rates happen on the right-hand side. All right, so that's tool one. If you're going to teach one tool, teach interest on reserve balances, right? But there are a couple other tools you can mention. Okay, the second one is the overnight reverse repurchase agreement rate. The important thing to remember about this is that not all banks or financial institutions have access to earning interest on reserves, and so it makes it not as an effective tool as sometimes we would like, and so we've have this other tool which operates in a very similar way, but is open to a wider group of institutions, right? So there's a larger group of institutions that can essentially deposit their funds at the Fed overnight and earn the interest on reserve balances rate. Okay, again, it's safe and it's liquid, so it operates in a similar fashion. The fact that it's open to a wider group of institutions means that this rate sets a floor underneath the interest on reserve balances rate. It's just kind of a secondary, insurance that the federal funds rate won't drop too far from interest on reserve balances. So that's the second one there. The discount rate is a tool from the old box. The old toolbox. Remember, the discount rate is when banks need funds. They can go to the Fed and borrow from the Fed through the discount window, which isn't really a window anymore. These are electronic transactions these days. But when they do so, they pay the discount rate. Okay, the discount rate acts as a ceiling for the federal funds rate. Okay, the reason it's a ceiling is because if you need funds, you can go to the Fed. If you're a bank, you can go to the Fed and you can take a loan. Okay, and that loan is guaranteed, right? So you would never pay more than you could borrow from the Fed, because why would you, right? The Fed is a legitimate lender, and so you wouldn't, if you were looking for funds, you wouldn't pay more than that. So the discount rate acts as a ceiling, and so by moving these rates together, the interest on reserve balances rate, overnight reverse repurchase agreement rate, and the discount rate, moving them together, these three tools guide the federal funds rate. And this is what it looks like in practice. This is another animated graph. The defining features here, notice that the supply curve isn't moving at all. Okay, that was the old regime. It was all about moving the supply curve. Instead, we're moving those interest rates higher and lower. So the interest on reserve balances rate, the overnight reverse repurchase agreement rate, and the discount rate, the Fed is moving them higher. And as the Fed moves those rates higher, the federal funds rate shifts along with it. Now, one of the key things to understand here, to take away from this, is that the Fed is no longer conducting monetary policy or implementing monetary policy based on the money supply. Right, so we're not shifting the money supply to get this done. Okay, rather we're shifting interest rates, and that's really a shift in focus from the old regime to the new regime. So when you listen to Chair Powell talk about monetary policy these days, he will never talk about what we're doing to the money supply. Okay, but you will hear him talk about what we're doing to interest rates. So what about open market operations? Okay, open market operations are conducted periodically to maintain ample reserves. Okay, so the primary function of open market operations these days is this: to make sure that the supply curve stays in the flat portion of the demand curve. Okay, assets roll off the balance sheet as they mature, and eventually, if it was, kind of unmaintained, the supply curve would drift back and it would start operating in this sloped part of the demand curve. And as it did so, it would make it difficult for the Fed to, control the federal funds rate with its other policy tools. And so the Fed uses open market operations occasionally just to make sure the supply curve stays in this flat portion. So this is the Fed's new toolbox, right? Interest on reserve balances, the overnight reverse to purchase agreement offering rate, the discount rate, and open market operations. You'll notice that I didn't include reserve requirements, okay? In March of 2020, the Fed announced that reserve requirements were being set to 0, okay? Which means that the Fed basically got rid of reserve requirements. And as a result, when they did so, the reserve requirements was dropped from being an active tool in monetary policy. Okay, so the way we think of it, rest in peace, money multiplier, March 26, 2020. We're not going to spend a lot of time talking about that right now, but if you're interested, we did write a page 1 article on this topic, teaching the linkage between banks and the Fed, rest in peace, money multiplier. So it talks about not only why the money multiplier doesn't work and why, it'd be a good idea for teachers not to teach the money multiplier anymore, but it talks about how banks function and how banks are able to facilitate transactions in the financial system without this idea of the money multiplier. So has policy changed enough to justify my instruction, right? That was the question we asked earlier. So in this is the old limited reserves regime, right? So we have the supply curve in the downward sloping portion of the demand curve. In the ample reserves, we have it in the flat portion. You'll notice that the demand curve doesn't drop all the way to 0 because these interest rates, the administered rates, are being used to move the federal funds rate higher and lower. And as the Fed, raises and lowers these rates, it's actually shifting this part of the demand curve. Okay, and same thing with the discount rate. As the Fed shifts the discount rate higher and lower, it's actually shifting the ends of the demand curve. So as they move these rates higher, it lifts this end of the demand curve higher, and the discount rate would lift this end of the demand curve higher. So it is basically an entirely different framework. So when teachers suggest, or professors suggest that, this is basically one more tool, but everything else is the same, we would disagree that this is an entirely different way of thinking about policy. One recommendation, we've been doing these presentations for about 3 years, and sometimes when we get to the point where we're talking about, arbitrage and the overnight reverse purchase agreement rate, people kind of are like, not as excited about it anymore, and people think maybe it might be too difficult to teach. And so we are, we're agreeing with that and saying that, rather than focusing on all 3 tools, just focus on interest on reserve balances. Okay, you can also include arbitrage, but arbitrage, once you break it apart, is really a pretty simple concept for most students. So we also talk about using a flow diagram. This is a flow diagram we developed as we started writing about this. And it's just a simple way to think about how Fed policy influences the economy. So in the first square, the FOMC sets the federal funds target range. In the red arrow, this is where the tool is used, right? Policy implementation. So this is where the interest on reserve balances rate would shift. And as the Fed shifts the interest on reserve balances, which then causes federal funds rate to shift as well, it affects other interest rates in the economy. Okay, so the shifting the federal funds rate will affect the short-term treasury rates. It will affect like the prime rate and other key interest rates in the economy. And as those interest rates shift, that influences the decisions of consumers and producers, right? So if we'll use today's example, or not today, but kind of our period in history is that the Fed is raising interest rates. So if we look at our scenario, the FOMC would raise the federal funds rate target range. Then in the red arrow, the Fed would raise the interest on reserve balances rate to make sure the federal funds rate was in the target range. That would cause other interest rates to rise. So we're in this box, cause other interest rates to rise. So this would be the prime rate, credit card rates, car loan rates, mortgage rates, etc. And those decisions, those higher rates would influence the decisions of consumers and producers. So at higher interest rates, there might be consumers who decide to postpone buying a new car or a different house, or businesses, they might postpone investment on expanding their business operations at a higher interest rate. And as those decisions are made, you get progress toward maximum employment and price stability. So again, in that scenario, we only mentioned the tools once, okay, and we mentioned only one tool. Instead, we're focused on how this plays out in the economy. All right, so here's a case study. Let's say that the economy weakens. Let's say in this scenario, employment falls below maximum employment. Let's say the inflation rate is steady around or slightly below 2%, but showing signs of decreasing. So in other words, these variables would suggest that the economy was softening and maybe headed for recession. Okay, maybe it's already in this scenario. Maybe the economy has entered a recession. So the question is, how can the Fed use as policy tools to achieve maximum employment or price stability? Okay, well, in this case, the Fed would lower interest rates. And by the way, I'm using little sections of a lesson that we just came out with. And this is one of the slides from that lesson. And you actually have these cards, and you give students each of these kind of oblong squares, rectangles, are cards that you have the students hold, and you have 8 students come to the front of the class, each one holding a card, and then you take this scenario and you talk about how this plays out in this flow diagram, right? So in this scenario, let's see. Let's go back to the beginning. All right, so in this scenario, the FOMC would lower the target range for the federal funds rate. Okay, then the Fed would lower the interest on reserve balances rate. So the students with these cards would raise and lower the cards to reflect that. This encourages lower market interest rates. Households and businesses would spend and invest more, okay, which encourages production and employment. And as that happens, the increase in employment would move the economy back towards maximum employment, right? So lowering the interest rate would move the economy back toward full employment. Here's another scenario. This one purely fictional, right? Inflation is rising. Inflation has been above the Fed's 2% rate for some time. Inflation is increasing, and the unemployment rate is very low, right? So let's say that this is the scenario. How could the Fed address this situation? Okay, again, if you use the lesson version, which I'll show you where to find it, you would have students in the front of the class with these cards, and they would raise and lower the cards to show how the different variables are impacted. And it would look something like this. The FOMC would raise the target range for the federal funds rate. Then the Fed would raise the interest on reserve balances rate. As that happened, other interest rates would rise as well. And as other interest rates rose, households and businesses would reduce their spending. That would discourage production and employment, and that would make sure that inflationary pressures started to diminish. So and then inflation would start to move back towards the 2% target. Teaching recommendations. Again, we've been presenting this information for about 3 years at conferences, workshops, all over the country, webinars, and these are the recommendations that we end up making at almost every single one of them. First, focus on the Fed's administered rates. So in other words, don't talk about, our recommendation is don't talk about the money supply, because that the Fed doesn't use the money supply to influence the economy anymore. Instead, we use interest rates. And by administered rates, we're talking about the interest on reserve balances rate, okay, overnight reverse repurchase agreement rate, and the discount rate. But again, if you're going to pick one, interest on reserve balances. Teach reservation rate and arbitrage as the key concepts. Refocus monetary policy discussion away from how the Fed influences the money supply and toward how interest rates affect the decisions of producers and consumers. Drop the multiplier and use a flow diagram. Now, if you're an AP teacher, the College Board is requiring AP teachers to teach both methods, right? So you have to teach the limited reserves, and you also have to teach the ample. If you're not an AP teacher and you teach this content, there's no reason to teach the old method, right? So, I would quit teaching the stuff that hasn't been true for, over a decade, and start teaching the new stuff. So your students are learning, how the Fed actually conducts policy. We have created a web page. We totally understand that textbooks have not kept up with these changes. They're just now starting to update their texts. I just got an email from someone at a major publisher today that said that all of their new titles, as they're revised, will have this new information, but that takes time. In the meantime, we're trying to support teachers as much as possible, right? So we've developed a whole bunch of classroom resources that you can use in your classroom in any way that's supportive. These are lesson plans, online modules, videos, articles. We have an FAQ page here. We kind of get the same questions asked over and over again, so we created an FAQ page as a reference. This is the lesson that I was talking about. Actually, it's an activity. It's not kind of a full-blown lesson. It's more like after you teach the concepts in class, you could pull out this activity and make it more of an active application. So the lesson is called How Fed Policy Transmits to the Economy. It's on the St. Louis Fed website. If you just Google that, if you Google St. Louis Fed, how Fed policy transmits to the economy, I'm sure it will pop up. Or if you go to our webpage, Teaching the New Tools of Monetary Policy, it's linked there as well. So the lesson is here, okay, the lesson plan, as well as the slides. And so these images are of the slides. All right, any questions? I just, kind of threw a lot of information out there in the last half hour, 45 minutes, I guess. Any questions?
No questions, thank you.
Okay,
Very
thank you.
interesting.
Thank you. All right, well, I want to thank you for your attention. And again, we do have this webpage, Teaching the New Tools of Monetary Policy. If you Google it, it usually pops right to the top. All of our monetary policy teaching resources are there. You can also email me if you have trouble finding what you're looking for. Drop me an email and I will send you the link directly and save you hopefully some time trying to find it. So I have a great weekend and a great Thanksgiving coming up.